Eric, it is set to be one of the biggest Canadian oil patch deals in over a decade, with energy giant Shell planning to take over Alberta-based oil and gas producer ARC Resources. In a written statement, Shell CEO says the $22 billion merger establishes Canada as a heartland for Shell. The Prime Minister labeling the move as a good sign.
It's a vote of confidence in Canada.
The deal comes as the federal government is aiming to fast-track two major LNG projects in British Columbia. Salism's, a proposed LNG export facility that would send over 20 billion cubic meters of natural gas to Asia annually, along with another project Shell co-owns, LNG Canada, which could double production.
For Shell, they understand all of this, and so they could see strong returns from LNG Canada Phase 2, and from developing this, and from the liquids that are associated with it. And it's, bodes well for everything moving forward together.
More Canadian energy agreements may be on the way, with companies seeking new oil suppliers due to global disruptions caused by the US-Israeli war in Iran.
Something big just happened, and it could change the power game forever. Shell plc just made a huge $22 billion move into Canada, showing strong trust in its future. But while Canada is winning attention and money, the US may be losing ground in a global oil race it once led. Shell plc announced it has signed a deal to acquire Calgary-based ARC Resources Ltd, a transaction that is Shell's largest acquisition in the past decade, one of the biggest deals in Canadian energy in several years, and the largest internationally since Chevron agreed to buy Hess in 2023. The announcement landed in the middle of a trade war, an ongoing CUSMA review, and a global energy market rattled by Middle Eastern conflict, and Prime Minister Mark Carney called it exactly what it is: a vote of confidence in Canada. After selling off a large chunk of its Canadian assets nearly a decade ago, UK-based energy giant Shell is now expanding its operations in Alberta and British Columbia by acquiring Calgary-based ARC Resources for $22 billion. The deal gets Shell access to ARC's holdings in the prolific Montney shale formation that last year produced 374,000 barrels of oil equivalent per day. That means a steady supply to feed into the LNG Canada facility in Kitimat, BC, where gas piped from northern BC and Alberta is chilled into a liquid state, loaded onto specialized tankers and sent to high-demand Asian markets. The Montney Formation straddling Alberta and northeastern British Columbia is one of North America's richest natural gas reserves, and this deal dramatically expands Shell's footprint within it. The deal combines Calgary-based ARC's more than 1.5 million net acres with Shell's 440,000 acres in the Montney Formation and adds roughly 2 billion barrels of proved and probable oil reserves to Shell's books. The acquisition would elevate Shell from the 7th biggest producer in the Montney to the No. 2 spot behind Denver-based Ovintiv Incorporated. ARC is primarily a natural gas producer, with average production of approximately 410,000 barrels of oil equivalent per day. The scale of the resource base Shell is acquiring, combined with its existing 40% ownership stake in LNG Canada, creates an integrated supply chain from wellhead in Alberta and BC through to the export terminal in Kitimat and onto specialized tankers bound for Asia. That integration is the strategic logic behind a deal this size, and analysts have been quick to identify its most significant implication. It's a good signal for the second phase of that LNG project that the government is looking to speed track, said Tom Pavick, president of Sayre Energy Advisors in Calgary, calling the Montney a world-class resource with attractive economics. LNG Canada's Phase 2 is the project behind that signal. Shell owns 40% of LNG Canada alongside Japanese, Malaysian, Chinese, and South Korean partners. The first phase of the project, the first of its kind in Canada, started up last summer. The consortium is contemplating doubling its capacity in a second phase, but a final investment decision has not yet been taken. Phase 2 of LNG Canada has been referred to the Federal Major Projects Office, which was set up last year to speed along approvals for projects deemed in Canada's national interest. The scale of what Phase 2 would represent is significant. A project description on the office's website says, an expansion would make LNG Canada the largest facility of its kind in the world and bring in $33 billion in private sector capital to Canada. Shell's ARC acquisition is the upstream supply commitment that makes a final investment decision on Phase 2 considerably more likely, because Shell now has the proven resource base to guarantee the gas volumes that would justify the expansion capital. RBN Energy analyst Martin King said, "It's a positive sign from the perspective that it certainly seems to paint the picture that Shell and its partners in LNG Canada look more likely to invest in Phase 2 of LNG Canada." Shell's interest in LNG Canada is an important strategic component of the deal, as it would help get more Montney gas to global markets that would pay a premium price, wrote Andrew Dittmar, principal analyst at Enverus Intelligence Research. LNG Canada is geographically advantaged for shipping LNG to Asian markets that gives it a competitive edge over US Gulf Coast competitors. That geographic advantage is the specific commercial argument that distinguishes Canadian LNG from American competition. LNG Canada's location on the BC coast cuts shipping times to Asian markets significantly compared to US Gulf Coast facilities, which must route tankers through the Panama Canal or around the southern tip of South America. In a market where buyers in Japan, South Korea, and China are paying premium prices for reliable supply, proximity matters, and it is measured in dollars per million British thermal units. The timing of the Shell ARC announcement is inseparable from the broader energy market environment it landed in. The deal comes as the war in the Middle East rattles global energy markets. The fighting has knocked out production from Qatar, one of the world's biggest LNG players, and countries in Asia and Europe have seen massive natural gas price spikes as a result. Qatar's disruption removed one of the most significant LNG suppliers from the market, at a moment when European demand is already elevated by the ongoing transition away from Russian energy. The combination of reduced Qatari supply and European demand pressure has created exactly the market conditions under which long-term supply commitments to Canadian LNG become attractive to Asian and European buyers who need reliable alternatives. Analysts at CIBC World Markets wrote in a report that Canadian LNG projects look increasingly attractive amid the war, given Canada's relatively low geopolitical risk. Sanctioning of LNG Canada Phase 2, Kaysai Lissam's LNG plant proposed further up the west coast near the Alaska border, have a high likelihood this year. The conflict in the Middle East highlights the advantages of Canadian LNG projects as reliable providers of liquefied natural gas from a stable jurisdiction with proximity to Asia. The stable jurisdiction characterization is not incidental. It is the specific quality that differentiates Canadian LNG from supply sources across the Middle East, from Russian pipeline gas, and from projects in regions with elevated geopolitical risk. Shell is making a $22 billion commitment to a country that US Commerce Secretary Howard Lutnick described just 11 days earlier at the Semaphore World Economy Summit as sucking off the American economy and lacking strategic leverage. The world's energy markets appear to have a different assessment. Between the high-quality gas in the Montney and crude in the oil sands, Canada represents one of the world's most attractive opportunities, Dittmar wrote. The deal required regulatory approval in Canada, the United States, and the European Union. Its announcement brings together the lead partner in Canada's only operating LNG export facility with the largest pure-play producer in the Montney Basin, creating a company with the upstream resource base, the downstream export infrastructure, and the established Asian customer relationships to capture the premium pricing that the current global supply disruption has generated. Carney headed to a cabinet meeting on Tuesday morning after describing the announcement as a vote of confidence. The cabinet meeting was about trade, about CUSMA, about the July 1st review, about Canada's negotiating position against an administration that spent the past year questioning whether Canada has anything worth taking seriously. Shell just committed $22 billion to the answer.